Hello and welcome. I'm Jeffrey Mishlove. Today we'll be exploring empirical research using news-based indicators. My guest is Peter Hafez, who is the Director of Quantitative Research for the data provider RavenPack. He has an extensive background both in the financial world and as a researcher with Sir John Cass University and Business School in London. Welcome, Peter. Yeah. Well, one of the other studies that you conducted that I referenced in my book series, The Alpha Interface, involved looking at how stocks react to news, particularly in the 2 to 3 day period after the news story came out. And I found that a very interesting study. Can you talk about that one?
Yeah, definitely. We basically created, can you say, using a similar approach, aggregating sentiment over some time horizon on a given entity, in this case on companies. We created a set of company sentiment indicators and looked for changes in sentiment for companies. And whenever we saw a positive change, we would, can you say, take a long position in a stock. And when we saw a negative change, we would take, can you say, a short position in a stock or sell the stock. Um, and we wouldn't necessarily do it across the entire universe of companies with positive and negative sentiment changes, but we would go, can you say, more in the extremes of the sentiment distribution, given that you could expect that those that saw the most extreme movements in sentiment would also be the stocks that would see the most extreme movements in stock prices. And what we have found when you start to look at some of these things is that first of all, the way the sentiment impacts stocks depend on a number of characteristics about the stocks. One of them, very not surprisingly, is the size of the company. So, for instance, you tend to see that small to mid cap stocks tends to react more to news than large cap stocks. And one of the reasons for that is most likely that it's very hard to get buy information on small to mid cap names. They're not as broadly followed by analysts, and not so broadly, can you say, covered by journalists either. So when they are actually covered by the news, it tends to really move the stock price. So that was one of the findings that we had. The other finding was that um, you uh, you would typically also see that the speed in which the news gets incorporated into prices also dependent on the size of the company. So, for instance, could take, let's say, a couple of days for news to get incorporated into stock prices. And here I'm talking about, can you say, some very simple signals, such as just a change in company sentiment. Um, it could probably take a couple of days on the positive side for large cap companies, but it could take, let's say, up to a week for negative news to get incorporated. Um, and again, for large companies, when you move into the mid cap to small cap range, it can last for weeks and perhaps even into a month for even relatively simple signals. Again, depending on the market you trade, whether it's the U.S., whether it's, let's say, the U.K. or Japan, for instance. So you can see differences there.
I notice you also found differences industry by industry.
Correct. There's definitely some industries where sentiment seems to be a stronger signals than in others, and typically here we find that some of those industries that have greater news coverage typically are also where you get stronger indicators, and probably it's because you get a better picture of what is, can you say, from a sentiment indicator point of view, that this is the trend of that company, right? Where for industries where you have little news, it's probably more valuable trading it from an event trading point of view rather than from a sentiment trend point of view. So we saw it working, can you say, be a stronger signal for technology, for financials, for consumer services and goods, where it seemed more challenging, let's say in oil and gas, or utilities, for instance. I will also add to that it, beyond, can you say, being more of a news coverage issue or how much journalists track these companies. I think it's also driven potentially by, can you say, these particular industries are driven more by, let's say, macro level changes. So, for instance, an oil company is very much dependent on what is the demand for oil right now, right? So, and obviously also just the general supply. And that is something that is more macro related rather than being, can you say, something you would pick up at when you talk about BP, for instance, in the news. So yeah, in the news.
Peter,
So
excuse me
yeah.
a second. You used a phrase a minute ago that I would like you to clarify. You suggested that there a distinction between event-based trading versus sentiment-based trading, and I wonder if you could just elaborate on what you meant by that.
Yeah, we typically work with two types of, let's call them, trading signals. One is where you do some sort of event-based trading, where it's, can you say, irregular to some extent, right? That you don't really necessarily know beforehand when an event or a trigger will be triggered, right? So it could be a simple event such as an can you say an analyst upgrade or an earnings beating expectations. That tends to be scheduled though, but there's still some surprise element to it whether it will beat or not expectation, right? But it could also be layoffs or can you say other types of unscheduled news. That's, can you say, a simple event. When it comes to sentiment trends, it's really when you start to build more of a sentiment indicator where you aggregate information over time. Let's say I'm going to look at the sentiment for this company over the past 3 months, and then I look for how that evolves over time, and I may look at it once a day, for instance, to evaluate what I'm going to do. So it has more of a regular type interpretation or use case, and that's really when what we mean by indicators. But of course, you could also create. This is, can you say, a very simplistic way of looking at it. You could, of course, create triggers or event triggers based on indicators themselves by saying, if I update my indicator in real time and I see a shift of a particular size or magnitude, then I trade. So they are kind of interlinked.
Hmm. So just to repeat what you were pointing out, if I heard you correctly, you were suggesting that the smaller cap stocks are more responsive to event-based indicators, and the larger cap stocks seem to be responsive more to the sentiment-based. Is that right?
There's no, it's definitely correct that can you say that the small to mid cap range definitely reacts more strongly to event based trading, but we also see these patterns for sentiment indicators as well, ways to capture a trend. But we have actually, interesting enough, and that was one of the other interesting facts about our news beta study, was that it actually seemed to work better for large than for small cap stocks. So you could actually create some very scalable strategies looking at news beta by creating, can you say, some value weighted portfolios that would do really, really well. And we're talking about, can you say, with a 1 year investment horizon, we're talking about information ratios of about 1.3. Yeah, so it's quite attractive for such a low turnover strategy.
Would you mind defining a little more precisely what the information ratio means?
It's for those that are familiar with the Sharpe ratio. It's kind of the same. Information. You can say that the Sharpe ratio is just this a special case of the information ratio. The information ratio, you will have your, let's say, annualized return in the numerator minus some benchmark. And can you say the benchmark in the Sharpe ratio is just a riskless rate, but for the information ratio, you could use whatever benchmark you want. It could be zero, it could be some index. Let's say I'm only gonna be, I only want to get, can you say, evaluated based on whether I outperformed the S&P 500. Then I would put in my S&P 500 as a benchmark in there, and then similarly to the Sharpe ratio, you would divide it by the standard deviation, or can you say the risk, the first or the second moment of your return distribution. You would divide by that. So you can say that the information ratio is the number of, can you say, the units of return you get per unit of risk.
Okay. Now, in your research, you've developed a number of trading strategies that you tested, and one of those strategies that particularly impressed me over a 10-year or 11-year backtesting period showed on average a 50% return per year. I have the graph of that in the alpha interface from your study, and that involved a very short-term horizon, I think holding for only a couple of days after news stories came out, based on the most extreme positive and negative sentiment indicators.
Yes, that's correct. The study that you refer to is can you say the one that we started talking about before, where we created these company sentiment indicators, and we found, can you say, these signals to be very, very attractive over the couple of days horizon. I will say, can you say, most of it was captured on day one after you saw the change, and there was definitely potential also to move intraday and capture more there. We basically moved in at the close price of the day of the change and exited on can you say, the following day.
So holding for one day.
Yes, correct, and that has delivered very consistent returns over the 10-year backtesting period. But some of the things that, can you say, the signals that were created in that particular study is probably more useful for, can you say, smaller investors rather than for big institutionals, because the way that we kind of, the most of the value we found when you started to move into the mid to small cap universe, and also and obviously the big guys want to be able to trade, can you say, certain pockets of money. So if they manage, let's say, $1 billion, they're not really necessarily interested in a strategy that has a capacity of a couple of million. So from that perspective, there's definitely some attractive returns to be made for those that want to dig in and let's say run a smaller pot of money. For instance, your one's own money, or can you say, some kind of proprietary setup, right? So that definitely some interesting things there, and it was very consistent, as I mentioned. It was profitable in every single year, yeah, it did really well.
Another one of the studies that I noticed recently that you had announced had to do with currencies.
Yes, that's correct. That's one of the new things that we have started to research. We launched our global macro product in September of last year. So we have obviously turned a lot of our internal research focus towards, can you say, this type of news to see if where there's value to be had. And we have found some very interesting results in the forex markets using this type of information. And we actually came out with our latest study last week. And so and basically what we have done here is that we have created a set of country level indicators that we have made available for people to purchase. So we would basically look at scheduled and unscheduled news that related to the U.S. economy, for instance, to create a U.S. sentiment indicator. And that could include anything from, can you say, economic releases to earthquakes and different natural disasters, really. So both human and human-made and natural disasters, as well as economic numbers, right? And what we based on this type of news, we created 8 different country sentiment indicators. One for the U.S., Eurozone, UK, Japan, Switzerland, Australia, New Zealand, Canada. So can you say the major, basically covering the major currency pairs? We then looked at when we aggregated then sentiment over different time horizons. So we would look at a 1-day sentiment trend, a 1-week sentiment trend, 1 month and 3-month sentiment trends. So basically creating a set of slow moving indicators, that is those that use long aggregation windows, and fast moving indicators. And you can imagine if you try to visualize it in your head, the 3-month aggregation window is ensuring that you have some indicators that are relatively stable, while the 1-day indicators are very volatile. And what we end up doing is basically trading currencies whenever we saw short-term sentiment on the U.S. economy, for instance, being more bullish than long-term sentiment. So whenever we saw a crossover, let's say from if the short-term sentiment value started from below and then finished above the long-term indicator, you would be bullish the US dollar. And if it started above and crossed below, you would be bearish the US dollar. And we basically did this strategy and traded 7 currency pairs that contained the US dollar in the cross. And we found that with about a 9 to 10 hour holding period, we were able to create information ratios that were about 2. So it seemed to work extremely well. And actually, we did this study. Can you say covering 2010 through 2012? So about 3 years. And we actually recently, can you say, updated it to see, how has it actually done in 2013. And that 2013 has been a tremendous year for this strategy. If you just focus on 2013 alone, the information ratio is something like 4.5. So it's done extremely well recently. We rolled that out into other currency pairs as well. So taking can you say other indicators as well? So looking at Eurozone, looking at Canada, as I mentioned before, and took the same type of view from the other side of the currency pair, right? So if you saw a sentiment crossover for the Eurozone, you would be either more bullish or bearish Euro. And we found similar type of results for that side as well, looking at information ratios about 2 as well. So there seems to be some information there that works very well across different economies.